everyone. My guest today is Lead Analyst Logan Mohtashami to talk about what is going on with mortgage rates following the Fed cutting rates yesterday. So Logan, welcome back to the podcast.
Yes, we're sitting here right now. It's Thursday morning. The 10-year yield right now is at 4.10. This is actually where I thought it should be after the retail sales report. But there's been a lot of volatility with mortgage pricing itself. First to the downside, where the 10-year yield had really good mortgage spreads, and then a very sharp reversal as well. While the 10-year yield has just basically moved 10 basis points back and forth. And sometimes you get this volatility puke up, sometimes on the downside and to the upside. And, of course, a lot of things change after Jerome Powell started talking. So clearly we have times, and to me, that 4% level, if you actually log chart out the 10-year yield, it's a line in the sand right now in that terms. But a lot of pricing for the good side has just been reversed. The market tends to take a little bit of time to work itself out, but a lot of volatility in a short amount of time, which is never a good thing because people have loans to get ready to lock, and some people might have been trying to play the Fed meeting, and those who locked before the Fed meeting were probably really happy. But the question is, this eventually does fix itself over time, and then you get better spreads and you go back to normal. But what about mortgage rates for the rest of the year now?
This is the big question. And I guess my first question is, was that move higher? And in the big scheme of things, not huge, but over a day, a big move. Is that because of actual economic data that we're getting? Is that just a reaction? What is it?
It's not the 10-year yield volatility. A lot of things change after Powell started talking, and things are being, winded out in market terms. So I was initially always surprised how low the 10-year yield was after the retail sales report that came out on Tuesday. Where it is right now would be, completely acceptable. We had jobless claims data was better today because the Texas flood is out of the equation. The Philly Fed manufacturing data, the new orders, the components were good. But mortgage pricing at times can get really, really extreme, even to the positive and negative side. And I think this is just kind of people unwinding things around a key level. But going out in the future, it's going to be a little bit different. And we've always said this. The market will always get ahead of the Fed. The bond market tends to overdo it to the up and down side at times, but it's really hard with Fed policy to get mortgage rates under 6%. I mean, there's a reason why I do not forecast below 5.75. If mortgage spreads got back to normal, you can get there, but to get that next leg lower, with neutral policy kind of priced in, it's just difficult. And now this is the third time this has occurred, but this is happening with job growth being at the lowest levels in recent history. And, the article that we wrote, we kind of highlighted, this isn't like all the sectors of the economy are slowly growing their jobs. We have very high unemployment for young workers. Black unemployment rate is, 7%. Manufacturing jobs are being lost for some time now. Residential, especially contract, have been losing jobs for some time now. And now residential construction workers losing their jobs. But the 10-year yield did a lot of the heavy lifting already for the Fed, like they've done before, like they did in 2023, they did it in 2024, and they did it again in 2025. But when you get down here, there's a reason why we go, you need a lot more things to happen or this is it. And I think there are people out there that just naturally assume that rates will just get back to 5% or something like that, like they're accustomed to. But this is why one of the things I've tried to teach this year is 65 to 75% of where the 10-year yield and mortgage rates can range is still Fed policy. It might not direct it in the Fed meetings or anything like that, but you are stuck in a range for a reason. And to get above a certain range, for the 10-year yield to get above 470, the economy has to be booming. This is one of the mistakes a lot of higher yield people make. And Sarah, you and I have talked about this for a long time. A lot of bearish people in America will say when higher yields comes, that's a really big, no, that's a sign that the economy is doing well, right? So if you're above 470, you were in the economy is going to outperform camp. If you are below 380, boy, the economy is really underperforming. But you could stay within a range in the 10-year yield and mortgage rates, and it looks perfectly fine with Fed policy.
So we've been talking about what could happen after the Fed was expected to cut rates, and we reminded people about last year at this time. No one needed reminding, I'm sure, because it was painful. Because here we had the Fed cut rates, and then mortgage rates, Fed cut Fed funds rate, mortgage rates went up, and this I think is part of what you're saying, that it makes the job of loan officers and realtors harder when they have to explain to their consumers, like, because everybody knows, oh, the Fed cut rates, hold, don't lock my loan, or I'll wait for lower rates. And we know it doesn't always do that. It didn't do that last year. And you had said in your article and in our podcast that you thought a lot of things were already baked in, right? Like the pricing was already baking in this rate cut. Do you feel like it followed kind of what you were thinking?
No, there's a lot of rate cuts priced in. I think that's the thing. I think there is a lot of Fed rate cuts priced in with where the 10-year yield is at 4% or even at 380. So it's really difficult to make that next leg lower. I think for those of you that remember me in 2023, like the Gandalf line, I didn't just create that out of thin air. I thought, boy, we have to be going into a recession if we're going to break this level. I just don't see the recessionary data, what people were talking about in 2023. So we should hold. And the Hodor line was created at 380. Now, the Hodor line was actually broken last year, which still to me is kind of shocking, but it was only for a limited time. The bond market can get ahead of the Federal Reserve because they can really believe that, a recession is happening. But jobless claims didn't break, and then bond yields reversed. Here, it's a little bit different. We only got a 10 basis points reversal right now. And mortgage pricing got really good because the spreads got good, and then it just completely reversed that trade. So this is the confusing part about markets and mortgage-backed security and that type of marketplace. But it is around an event of the Federal Reserve. So we always say the bond market will get ahead, but if you don't kind of deliver, these things do happen. And I think the verbiage was the thing that bothered a lot of markets. But in this case, the 10-year yield at 410 looks perfectly acceptable with where Fed policy is out there, because they still are in their minds modestly restrictive, and they quite don't believe in the weaker labor market. If you listen to Powell yesterday, I mean, again, I harp on this, and I harp on this for the rest of my life. If you are telling America that the break evens are zero, that we could have no job growth whatsoever, we have more. See, the Federal Reserve loves the job openings data, but the job openings data right now has more unemployed workers than people than job openings. All right, that was one of the data lines they always harped on. Here, zero job growth is completely fine. Manufacturing jobs have been losing jobs since late 2022. We had huge population growth rebound, and they still lost jobs. Residential construction jobs, especially contract. These are not population growth stories. These are rate stories, right? These are capital investments. So it is a good in some of the sense that the Fed funds rate is coming lower because the short-term borrowing costs are going lower. And this is one of the reasons why we think that Trump's real policy is maybe to push ARM loan lending if the long yield. But this is a very short volatility spread, and I totally get it. This is where I feel bad for everyone, because people are like, oh my God, they had this refinance all ready to lock and everything. All of a sudden, bam, and you're just basically, it's a loan stuck in the system that can't do a rate and term refinance now.
Okay, so let's look. We've got 3.5 months left in this year. So from your perspective, are we about what we can kind of, is this the level of mortgage pricing that seems like this is the right level?
Sarah, it is very difficult to get under 6%. And I say that because Fed policy is still modestly restrictive. And this is now the third time in a row, right? This is 3 years in a row. So you have very limited downside with rates. Okay. And then you're more evenly priced now. I think Mortgage News Daily went from 612 to 622 to 635 in a very short amount of time. So a lot of negative pricing. Convexity is actually in the system right now. But To get below 6%, right, you do need a lot of stuff to occur. And we listed those things in the article out there. But it isn't shocking that we always get to this level. And it isn't shocking that for the third year in a row, the Fed comes out and goes, "Whoa, wait a second. They could have just let it go. They could have
Yep.
had a dovish statement, but they didn't." And that's my thing. This is done on purpose for a reason. This is now the third time when rates get down to this level and they're just not comfortable. Okay, so it's not like Neil Kashkari coming out and basically saying we don't want mortgage rates at 6%, but it's not shocking that they try to get the markets to not go much lower out there. So crazy 2-day period. It's crazy in the sense that the 10-year yield isn't doing much, right? But this is the volatility sometimes in the mortgage-backed security markets that can happen. Eventually, it fixes itself out there. But you could see that around events, certain trades, Godzilla tariffs was one of this. Like Godzilla tariffs took the 10-year yield to 3.87%, but mortgage rates were higher back then, even at the lows of Godzilla tariffs, just because the spreads were worse. So this happens from time to time, but going out in the future, it's just keep and remember, if you're looking for near 6% or sub 6% mortgage rate, you either need the mortgage spreads to get much better, you need the Fed to get dovish, or you need the labor market to get broken. And with modestly restrictive policy, that's what it looks like. And this is why I think the ARMs are going to be something the White House talks about, because you can get sub 6% mortgage rates with ARMs, and the builders have shown you this is a way to grow sales out there. But an unfortunate volatility day that I just think not a lot of people get, because they don't see the 10-year yield really having a crazy day, and it's at 410. But if you think of it, it was higher rates when we were at 4%. With Godzilla tariffs. So the spreads have improved from those levels, but sometimes you get one or two crazy days and it works itself out over time.
Crazy days, yes. I would encourage anyone to go look at the article that Logan published about this, because it does have a lot of detail about, okay, this is how it could go lower. These are the factors that would have to be there for rates to go lower from here. Here's what could happen to raise them higher. Also has charts, which are always very helpful. So from the Chart Daddy. So Logan, thanks for being on. Thanks for explaining what's happening.
My
Appreciate it.
pleasure, Sarah.